critical insolvency. And from the numbers, I believe a lot of people have crunched the numbers. You've seen that the company is gradually going under. So it's a dicey situation, and it's good you pay rapt attention to the numbers. A lot of analysis are going on, a lot of Preseen analysis, but it's very easy to come by because a company that is going under like this, the company will really need a savior. It will need conclusions, recommendations that can bring them out of this ditch. So the big picture is that we have a company that is seriously distressed financially. And from the numbers, you can see that the company is going down. So everything about the company is in shambles. Compliance issues, regulatory issues, ethical issues are replete in this scenario. So as we share some thoughts and ideas, I want you to pay rapt attention to them, and you'll get some idea on what to write, how to write it, present your thoughts clearly, and above all, follow the format of the examiner. And I believe no matter how hard the numbers are, you should be able to crunch them because you've been practicing all this while. And I believe you're going to ace the paper very seamlessly. All right, so having said that, I would like to confirm if you can hear me. I believe you are hearing me. I saw Mr. Akman's emoji. So maybe somebody unmute your mic and speak. And you can also see my screen also. Okay, Lola, I see your hands up.
Good evening, sir.
All right, good evening. Okay, fantastic. Yeah, thank you. Thank you, Madam Yetu. Thank you. All right, so let's get to work. Let's get to work quickly. So we start with the Preseen. I believe we've gone through the Preseen a lot, so we'll not take much time exhausting and looking at the Preseen. So we have 5 exhibits provided to us at the Preseen level. Now, the 5 exhibits came with numbers. So you have numbers here as the 5th exhibit. So the numbers have shown us what the company is going through and what the challenges are. So you have the first exhibit that is to you. So you are wearing the hat of Tokunbo Adeolu. And what's your role? Your role is an audit trainee because you work for Garba, Chukwuemeka, Adelani and Co. So in starting your cover page, I know a lot of people like the block format. It's fine, but I prefer this format. I don't know what to call my format, but the block format is okay. I like the letter headed of the audit firm. I coined out this address. It's optional. If you like, you coin it. The address, the phone number, I coined it, is not in the scenario, is not in the exhibits. Then the email is also not in the exhibit. So this is coined by me. I coined it out. So this is your letter headed. And you're writing to the board of Sadeco. So Sadeco's address is Akure. If you look at the exhibit, you see the background of the company. That informed my decision on knowing where Sadeco is. It started from Ondo State. So I coined the address here to the board of directors of Sadeco. Then the report is on requirement 1 and 2 based on the predicted unseen I provided. So evaluation of the financial position and performance, and an evaluation of the viability of the proposed strategic alliance with Euroco AG, or Eurochoco, I beg your pardon, AG. So this is requirement 1 and 2. You summarize it. Then the report is prepared by Tokunbo Adeolu or the audit firm. Why I'm not using the audit firm is because the letterheaded already shows the audit firm. So I'm using Tokunbo Olu, the person in the scenario, the person you are. If you use the audit firm, you'll not be penalized, but I use the person in the scenario. So make your choice. It's not an issue for debate, whether you use the audit firm or not. Anyone you use is fine. But personally, this resonates with me. And that's why I use it. So the date of the exam is the day you are writing. So that should be the date of the report. And don't forget, it's an external report. So you must put a disclaimer. You must put a disclaimer. Take note of that. That what is not you should put, you must. And take note, if you don't put a disclaimer for an external report, you are going to be penalized. So take note of that very, very seriously. You must put a disclaimer for an external report, which is what this diet is. Okay, so having said that, and it's not a strict class where you don't have to speak. If you have very tenable clarifications, concerns, interjection, please interject, but don't waste our time with frivolous questions that are not called for. You just want to speak. Please don't waste our time. We don't have time. If you have something very urgent, please go ahead, raise your hand. I would give you the floor to speak. Serious questions, please. If it's a question you could address by yourself, there's no need bringing it to the fore. We don't have time. You see, because of rain, we couldn't start on time. So please, serious questions. If you have them, bring them on. All right. So first exhibit has shown us who we are in the scenario and how your page should look like. Your cover page should look like. That's the first thing. So you have your key responsibilities that includes preparation of financial analysis and reports, analysis of financial statements, assessment of business proposals, evaluation of forecasts and assumptions, strategic tax advice and planning, then draft analytical report. Now I must warn you, because I've already put a disclaimer. I put a disclaimer in this Preseen. And in the disclaimer under the unseen, I said you should not cram and don't expect this exact requirement in the exams. Nobody predicts ICAN. I don't have any relationship with the examiner. And I don't know the examiner. So this is for practice purpose. So don't cram this unseen and the requirements and expect to see it in the exam and go and write the report exactly. This is for practice. This format is for learning, is for preparation. It's not for cramming, because some people are very good in cramming. They will cram the requirement, cram the suggested appendices and the computations, and when they get to the hall, NEPA takes light, then there's problem. So I must warn you, the requirements can come from anywhere. This suggested or unseen document I provided is for practice, familiarity with the scenario that explicitly deals with Sadeco. So please don't cram. So your responsibilities here includes financial analysis of financial statements, assessment of business proposals, evaluation and evaluation of forecast and assumptions, strategic tax advice, drafting analytics. So the requirements could come from any of this, your responsibilities. And if you see what I used a business proposal based on this requirement 2. And I also use preparation of analysis and financial statement for requirement 1 to coin out requirement 1 and 2 for practice, for you to sit down, read the numbers, practice the numbers, practice report writing. That's the essence of this, not to go and cram and say, okay, Josiah knows the examiner, he has seen Expo, so let me cram it. That's not the purpose of this Preseen analysis. ICAN is smarter than that. You can't know what they will set. Nobody knows what they will set until exam day. And let me break the ice for you. Your requirement will be set that morning of the exam. Your paper will be flown that morning of the exam. So I don't know. If you've ever had ICAN paper leaked, it will never leak. So have that at the back of your mind. If you've had ICAN paper leaked, then let me know. ICAN paper has never leaked since inception, and it will never leak. So take note of that. This is for practice purpose, and please practice with it. Don't cram. Don't cram. I must sound that warning, because a lot of students like to cram. A lot of candidates like to cram. Don't cram. Understand the format. Understand what is bedeviling the organization, the case study. Understand what is the problem, how to submit your thoughts. Exactly how I've provided the solution for you to submit your thoughts like that. So if the scenario changes, if the requirement changes, if he asks you to use a model, if he asks you for what other areas, pepperish areas does the examiner ask? Okay, if he asks you for intercontinental or intergroup or what word do I want to use for this? His geographical location kind of requirements. If he asks you for that, you will understand how to navigate it because you already have practice. So if he says use Ondo location, use Lagos location, use Abuja location to prepare financial statements, and he brings numbers from those 3 locations in the unseen, you know how to navigate it. You don't just cram what I've done and you expect that in the exam. So please expect anything. Expect anything. That's very important to state at this stage. All right, so having stated your responsibilities, to effectively fulfill these responsibilities, you are to keep abreast of developments in accounting and taxation sectors, as well as matters relating to business sustainability, both on a national and large scale. So you see, injection of sustainability is a possible requirement also. So be prepared in case sustainability shows up. He said, this commitment to ongoing learning ensures that your work reflects current best practices and supports the firm's client in achieving their objectives. All right, so we have Exhibit 2, generally on the cocoa business in Nigeria from the golden era to challenges and revival, 1960 to present. So that's Exhibit 2. You must have gone through that. Now, Exhibit 3 has cocoa processing industry in Nigeria, an overview, current status, and production volume, export orientation, the Nigerian cocoa processing industry, a detailed assessment, and so forth. So many informations here, and very importantly, SWOT. Very importantly, SWOT, strengths, weakness, opportunities, and threats. So strengths and weaknesses are internal to the organization, while opportunities and threats are external to the organization. So take note of it in case he asks you to use SWOT in any of the requirements to solve it. We also have challenges facing the Nigerian cocoa processing industry. And you have Exhibit 4, Sadeco Processing Limited, the company structure. So take note of it. You have the chairman and the MD, and you have the MD also, who are members of the board. You have the ED on finance and strategy. John Eze is also a member of the board. Dunia Abioye, marketing controller, is not a member of the board. I'm sure he's a normal manager. Supply chain controller is not a member of the board. Ibiyemi Adebola is not a member of the board. Michael Abimboye, human resource controller, is not a member of the board. John Omiyale is not a member of the board. So you have three non-executive directors, one executive director, a managing director, and a chairman. Then you have current challenges, which are lack of working capital, delayed payment to customers, high interest rates, outdated plant, inefficient inventory management, poor financial planning. And they said these challenges have resulted in a number of adverse consequences, including inability to. So you have several challenges here. You have international rejection of products, which includes some ethical issues, ethical and critical issues that should come under your ethical issues box. You have the repercussions, you have strategic direction, the way forward, and you have financial restructuring, which is part of the way forward, working capital management. Then you have quality improvement and certification as the way forward, backward integration, and strategic alliances. You also have risk and mitigation strategies to help address that. Then you have the numbers. So you can see the numbers here are strategically provided. So the numbers are very replete with issues. From 2022, you see there was a drop in property, plant, and equipment from 571 million to 549. Inventory also dropped from 88 to 72. Trade receivables 24 to 15. Prepayments increased from 2.6 to 2.7. Fixed deposits almost the same, 13.5, 13.6. Cash and cash equivalent dropped from 4 million to 3.3. So the total current assets dropped from 133 to 107. Take note of that. Equity and liabilities. For equity, there was a drop drastically by over 50%, from 110 to 50. Non-current liabilities dropped from 9.9 to 8.3. Sorry, 113 to 111. So there's also a drop in the total equities from 704 to 656. Revenue dropped from 217 to 161 in the income statement. Cost of sales also dropped from 236 to 185. And cost of sales is above revenue. Take note. Cost of sales also above revenue, culminating in a gross loss. They had other income, but still the other income couldn't cushion for the loss in the gross component. Come and see operational losses also of 36 increased to 38 million. Loss before tax 64 to 61. Loss for the year after tax 60 and 61. So the company is really in shambles. Profitably, it's not profitable for both years. So that's the numbers for the financial statements that was presented in the unseen. So if you look at the predicted unseen I provided some context, and the unseen I provided, I tweaked the numbers and came up with some additions. So it's good for you to take note of the unseen. And if you look at the unseen, I came up with 4 exhibits. And the exhibits are from your supervisor to you, from the finance director of SCPL, and the strategic alliance from Eurochoco, and a letter from National Cocoa Quality Control Commission. So now the letter is giving you your requirements here. So take note of the requirements. This is the first requirement. And you need to take note of some items here, which says you should address ethical issues, consider the issues in the industries on ethical practices, and also any relevant issues. The requirements 2 are everything here. So the examiner is going to tweak the requirements. Don't get confused and say there are 5, there are 6, there are 4, there are 3 requirements. There are only 2, only 2 requirements. Always only 2 requirements. He will put it in splinter houses or scatter them across several Roman numerals or whatever. There is only 2 requirements. Read in between the line and join them. So this is requirement 2, and this is requirement 1. Very simple. So don't get it twisted. Don't get yourself confused. There are always 2 requirements. There will always be 2 requirements. So based on these requirements, there's an additional information that was provided, and for you to be able to tweak. So you have some numbers here that you need to adjust. So first is obsolete inventory. A physical count revealed that 12.5 million of cocoa beans cost have deteriorated due to poor storage, and the net realizable value is 3.2. So you need to adjust the numbers. So if you look at the solution, you see that there's a write down. So if you look at the solution here, I provided the appendix table here. So you write down the inventory. This is the adjustment item, and this is the rule, the nature of the adjustment. So the amount you write down is 9.3 million. So you increase cost of sales and you reduce inventory. That's the accounting impact, the journal entry. So that was what I tweaked. The examiner may not come that way, but it's just for you to practice. All right, next is for unrecorded liability, farmers cooperatives or farmer cooperatives. The company has an obligation of 8.7 million owed to 3 farmers in December 20. This is not recorded in the trade. So to adjust that, you come to the unrecorded liability that was omitted, the trade payable, and reduce it by this amount. Then you increase trade payables, and you also increase the net expense. That's your adjustment. Now for the impairment of plant, the obsolete processing plant has a carrying amount of 320 million. An independent valuation indicates a recoverable amount of 245 million. So you come and adjust the impairment of plant by debiting property, plant, and equipment, and you increase the impairment expense by 75 million. Then for the customer dispute, the export shipment, we have a rejected cocoa amount of 22.5 million, which was included in revenue. The shipment was rejected due to pesticide residue. Management estimate is 60%, maybe irrecoverable. So for this, the revenue overstatement has to be reduced by 13.5. So you debit revenue and also debit receivables of this amount. Then for the ethical issue, there is no accounting adjustment for that. You just bring it up under your ethical issues box. For conflict of interest in this scenario, where this director owns a logistic company that receives 4.2 million in payments from SCPL as this amount, this was not disclosed. This also does not have any accounting impact. So it's 10.5, but there's no accounting impact. So your total adjustments, or the total adjustment we have, is about 116.5 million. So take note of it and practice with it. The essence is for practice, very importantly. So one of the things the examiner loves, sometimes he will ask you to do a trend analysis comparing year by year how the organization has performed. So I did a trend analysis for you here between 2022 2023. You check your assets, how they fared. So after the adjustment, you have a 17% change. 17% change. So for 2023, the asset increased based on the adjustment. Then for current asset, we reduced inventory by 9.3. Then for trade receivables and revenue, we reduced it by 13.5. So that made a change of less than 10% based on our adjustment. So we adjusted the figure 79, and we have for 2022 88. It's still reduced by this amount. So there's a reduction or change between both years by 10%. Trade receivables also, after the adjustment of 13 point something, we have 54.50% negative, because this current year is lower than the previous year. So we have it negative. Yes, please, Lola, your hands are up. Please go ahead.
Yes, sir. Please, I want to know this change, how we are, the adjustments. I'm confused. I'm trying to follow you, but please help me to be able to follow you in order to understand these changes, how we are doing the adjustments, sir, please.
Okay, so like I said earlier in these adjustment figures, I've given you the accounting impact. So you are changing inventory, you're going to increase cost of sales, and you're going to reduce revenue. So if you go to the scenario where we have the issue now, the additional information is for 2023 financials, the current financial statement. So everything you're going to make adjustment is for 2023, not 2022. 2023 is going to be impacted. So for example, your obsolete inventory affected 2023. So the write down is between 12.5 million and 33.2 million. This is the current net realizable value you are writing it down to. So in your computation, you're going to increase cost of sales, because it's a cost for you, the amount that was written down, and inventory is going to drop. So you're crediting cost of sales and debiting inventory. So in the adjustment here, you're going to have your inventories as reduced for 2023 by 9.3 million, because that's the amount you wrote down based on that adjustment. So when you write down the amount, you reduce 2023 figure by that amount. So if you go to the financial statement, you see inventory was 88,369 originally. Now, when you effect that adjustment, it's going to drop to 79. So from 88, you removed 9.3, and that culminated in 7.9. So 7.9 minus 88 is negative 10.5. Sorry, 79 minus 88 divided by 88. So the change is going to be old minus new divided by new. Old minus new divided by new. So 2023 divided by 2022, 2023, sorry, minus 2022 divided by 2022. Do you get that change now? You want to see the change between both years. Is that clear now, Lola?
Yes, sir.
Okay, fantastic. You still need to go back and practice because these are areas he didn't ask for change in the last diet. So you may need to, he may ask for change between both years. You say you should compare both years. We don't know if he will ask you for that in the requirement. And that is why I brought change here. You need to see the change between both years. Yes, Mr. Isaac's hand is up. Isaac, go ahead.
Yes, sir. Sorry, I just want to know. You say old minus new divided by what? New.
Divided by new, yes. That's how you get the change. The change in
Thank you.
percentage, yes.
Thank you.
All right, you're welcome. So you do that for receivables. There was a write down of 13.5 for receivables, and you see the change dropped also. So for prepayment, there was no adjustment. Fixed deposit, there was none, and the figures remain the same. So there is no change for prepayments, fixed deposit, and cash equivalent. So in the overall total current assets, you have a change between 2023 and 20. There was a drop of 17.10%. 17.10%. So this 22 million is the total of these two figures that were adjusted. All right, so this is the same amount for total assets when you add the two figures and the amount you effected the adjustments. So for equity, we have the same amounts down to fair value and all that. But for retained earnings, for 2023, there was an adjustment of retained earnings. So in 2022, we have 775 negative loss or negative retained earnings, accumulated losses. It increased in 2023 to this amount because we made a change of this. So if you go to the the predicted unseen, you see that there is an obsolete processing plant and of 320 million, and an independent valuer indicates the recoverable amount as 245, and depreciation for this plant of 2023 is about 15 million. So if you look at that figure for retained earnings, the amount in the reduction of the plant is what will culminate in this reduction, and it will increase our retained earnings. So from the initial retained earnings, you see we have 816 in 2023 loss, accumulated losses. Then we have 755 accumulated losses for 2022, accumulated losses for 2023, 716. So after you've effected that write down based on the adjustment here in the impairment, you're going to have your 2023 figure go up because of it was 816. Now it's going to go up by 816. You have initially as 2023, and it has gone up by 888. So it has gone up by 72 million, and that amount is as a result of the difference between the carrying amount and the recoverable amount. So the carrying amount is 320 and the recovery amount is 245, and that culminated in about 75 million, and that is why you have your retained earnings absorb that difference. So your retained earnings or accumulated losses has increased by that amount, and that is why you have an increase in retained earnings or increase in accumulated losses based on this adjustment. So take note of it as you are practicing. Your carrying amount minus your recoverable amount is your impairment, and it will affect your retained earnings. So as you practice, take note of that. Okay, so after you've adjusted for that figure, you come up with your change. So you compare this, and you have an increase of 17%. Then for non-current liabilities, there were no changes, so everything remains zero. The figures for 2023 were the same for 2022. Then for current liabilities, your trade payables is going to be adjusted for the amount based on the additional information that was provided here to you. So they said SPL has an outstanding obligation of 18.7 million, and that's why that adjustment was effected for your trade payables. And your adjustment is increasing the payables to 255, and you also have 7.9% increase in trade payables. None for borrowings, and your total liabilities is just the trade payables that were affected. So a key interpretation I gave you here is that take note of total assets that fell. Total assets fell by 17.43%. And why was that fall? There was inventory written down, there was significant receivables adjusted, and also PPE impairment. And we said equity dropped also by this amount due to the cumulative losses. We said also liabilities increased due to unrecorded obligations. So the statement reflects weakened financial position and solvency problem. So the company is facing technical insolvency. So take note of that based on that key interpretation for you. Next, I provided in this appendix is common size analysis. Yes, please, Isaac, your hands are up.
Sorry, sir,
Please
just
go
a
ahead.
little. Yes, sir, just a little bit. Go back to what you just said. I want to capture it. I didn't get it. Sorry.
Yeah, so I'll share
Yeah.
this report now. You get this report. There's no issue. I'm not keeping this report with me. You get this document after the class.
Share it as a document, not as a video. Huh?
No. It's going to be on YouTube, and you're going to get this PDF document, this solution after the class.
Okay, thank you.
Yeah, you're welcome. So like he said I should go back to what I said. So I said a key interpretation for the exam is that based on what we've seen from these financials, we just saw the change in the assets, and what we just saw from the change and the issues from the adjustment is that this company is technically insolvent, and there's a challenge with the assets where it fell by 17.43%, which is driven by inventory write-down, significant receivables adjustments, and also the PPE impairment that affected retained earnings. So we have our equity dropping. We have 83.83 decline due to those accumulated losses, and liabilities increasing due to unrecorded obligations. And finally, we said the statement reflects weakened financial position and solvency pressure. So that's what the company is going through. So take note of it. And next, I said I prepared common size analysis. So common size analysis are analysis between both years, having a base for your income statement as revenue, then for your statement of financial position as your assets. So we have a base we want to compare. The base is for comparison. So what is the percentage of cost of sales? So we based on the base of revenue as 100%. You see cost of sales has swallowed it up. And you see my comment here. Based on this common size analysis, the very high cost structure worsened in 2023 due to inventory write-down and adjusted losses. So you see your cost of sales is already 108% of your revenue. I mean, the company is doomed. You don't have any other thing. That is why you have a gross loss of 8.9% in 2022 and a gross loss of 14.5% in 2023. So you use the numbers as a base. So the revenue figures for 2022 is this amount. And after you adjust your revenue, you have 161 as the base. So if you compare the figures of your cost of sales literally with these revenue figures, and you say times 100 over 1, that's where you get these percentages. And that's what common size means. Size up the amounts of revenue from your income statement with other parameters or other components as a percentage to see how much, for example, cost of sales is taken out of revenue. What percentage of cost of sales is going from revenue? So you see cost of sales is already swallowing up revenue with additional cost. And that culminated in the company's gross loss, other incomes and all that. Everything about the company, you see, it has a weakened financial position. So this common size states the company is in big problem. And the loss for the year after taxes, if there is any even charge for taxes, any need for that, you see there's a severe deterioration in overall profitability. So take note of this commentary because you use it to write your report. I put this commentary there purposely for you to learn, know what happened to the numbers, and you use it to write your report. Now for the SFP, the base is your total asset. After we adjusted 2023, the figure came to 583. So based on that, you see that our PPE slightly declined due to impairment adjustment. So our PPE is 81% of our total asset in 2022 and 2023. And for our non-current asset, we have inventory 12.5 for 2022, 13.5 2023. Receivables 3%, 1% in 2023. Cash, very insignificant, 0. Then other assets 2.2, 2.7. Total assets 18. So use the numbers to flex them. And this is quite technical under exam condition. If you don't need to do it, the examiner will not ask you to do common size analysis. Don't do it. If you don't need to do it, if he doesn't ask you to do it, don't do common size analysis. It's going to waste your time. Don't do common size analysis. So the key interpretation for this common size analysis is that this company shows severe structural weakness in profitability with the gross losses, and the equity base also eroded. That means it dropped, indicating solvency risk. Also, high reliance on current liabilities suggests liquidity risk, and the cost structures remain unsustainable, especially the cost of sales, because it's worsened by impairments and adjustments. And the company is moving deeper into distressed financial position. That's what this common size analysis shows us. So, like I said, it will waste your time. If you're not asked to do it, don't do it under exam condition. This is very important. Now, let's go to what you'll be asked to do, ratio analysis. So based on the numbers, our profitability ratios, which is possibly what he will ask you to do on profitability, you look at the gross profit, you see that there is no gross profit, is a gross loss because it's negative. So we have a gross loss of 8.9%. After the adjustment of revenue, you also have, adjustment of cost of sales, you also have further 14.55 negative. And what does this mean? Is deteriorating cost of production, impairments have significantly worsened the gross performance. That's what it means. Now, if you want to do operating profit margin, you don't have operating profit, all negative. This is also worsening because core operations are loss-making with rising administrative inefficiencies. Net profit, we don't have net profit. We have a loss of 27.74%. And in 2023, it increased. Severe decline. Overall profitability has significantly worsened. Return on capital employed. Operating profit over capital employed, which is your total asset minus current liabilities, you have it all dropped. It's negative and deteriorating, indicating inefficient use of capital, poor returns to both equity and debt holders. Return on asset. Now, you can't do all these 6 under exam conditions for practice. Pick the most important 3. He may not even ask you to do profitability because there was no profit. Maybe he wants you to analyze if the company was profitable or something, but profitability, I don't think he will ask you because there is no profit to analyze. Everything is on the negative from this parameter or from this component. But then you understand the interpretation. The numbers are telling you something the company is going through. So from the return on equity, you see extreme negative figure due to collapse of equity base. What is return on asset telling you? Asset base is generating worsening negative returns. So everything about profitability in your interpretation shows the company is already doomed. So take note of that. Now we move to efficiency or efficiency and activity. If you look at inventory turnover, it's 136 days in 2022 and 165 days is also deteriorating. Receivables improved from 41 days to 25 days. However, the improvement is partially due to that revenue write-down from disputed export shipment. That's why it improved. Creditors deteriorated 365 days to pay creditors. That's 1 year. When the normal standard best practice rate is 30 days, it's 1 year in 2022, and it moves to another 547. Yes, please. Any your hands are up. Please go ahead.
Yeah, okay, so I wanted to get this clarification. There's a place I saw for inventory turnover. They said cost of goods sold divided by inventory. So I wanted to get this clarification today.
Okay, so there are two variants. You have the inventory turnover in days. So it's days we are doing. And you have the inventory turnover in times. This is activity. So there are two variants of that formula, of that ratio. So one is for efficiency and one is for activity. So you can see where my pointer or my mouse is pointing. This is days to show how many days, and this is times. So you just swap the formulas or the numerator and the denominator. So for inventory turnover is inventory divided by cost of sales. And for inventory turnover in times, you do cost of sales divided by inventory. So normally this is not actually inventory turnover. It's actually inventory holding period. We call it inventory holding period. Then this is inventory turnover. There are two different terms for it. So inventory holding period is in days. The inventory turnover is in times. I think Blessing's hands came up. Blessing, are you trying to clarify something, or you want to provide credence to what we are saying?
No, you have corrected it, sir, so no issues.
Okay, fantastic. So who asked that question again on both questions? Both. I hope it's clear. I think it's Ene, right? Ene, you asked on inventory turnover. You were trying to clarify the formula.
Yes, sir.
Okay, so it's clear now, right? Okay,
yes,
good. Sir. Okay. So you can see that the inventory days is increasing for inventory. It's just receivables that dropped because of that write-down. Creditors skyrocketed, significant increase, and is showing serious distress. And when you come to the activity ratios, asset turnover is less than 1. So there's declining efficiency in asset utilization. For inventory, falling inventory efficiency. For fixed asset, decline productivity. That means they are not even using their asset to generate revenue, enough revenue. So assets are underutilized. So these parameters are also on the fall. They are coming down drastically. Now for liquidity, we have the current ratio, quick asset, quick ratio, and also cash ratio. For current ratio, you see is critical. It's even below 1.1. Normally the standard is let this be 2:1. Let your current asset cover your current liabilities at least one time. You see, this one is not even up to once, indicating severe short-term liquidity pressure. Quick asset, extremely weak position once you remove inventory. Cash ratio, very weak. So everything about liquidity, the company is going through stress. Now, I also added cash conversion cycle. You don't need it under exam condition. It's for practice. Cash conversion cycle, you are saying inventory days plus revenue plus receivable days minus payable days. So cash conversion cycle, you see it's negatively 188 days for 2022 and negatively 357 days for 2023. Interpretation is that the negative cash conversion cycle is due to heavy supplier financing, and for 2023 is even more negative because it indicates extreme reliance on creditors for working capital. So this is for practice. Under exam condition, you don't have time. So don't go and do cash conversion cycle. It's the result and the interpretation you can interpret based on inventory days, receivable days, and payable days. So it's for practice. When we go to gearing, we see that gearing is highly alarming. Debt to equity ratio is about 534%. Total debt is higher than equity. For 2023, it's about 3,000. So the equity erosion has made the company extremely overgeared and financially unstable. For equity ratio, we have equity divided by total assets is a severe erosion also of the equity base, the results. Debt ratio also near total. In fact, everything about the company is debt. debt to assets, the financial structure is about, let's say, 90 to 10. So the interpretation here is that the company is deeply making loss with all profitability ratios negative, return on capital employed confirms poor capital efficiency and destruction of shareholder value. Liquidity is critically weak. Gearing has reached dangerous levels due to collapsing equity base. And overall, the company's characteristics is of a financially distressed company. Take note of this word. This company is financially distressed. It's financially distressed. So take note of that and take note of it pragmatically. All right. So those are the numbers. They are not the only things the examiner will ask you, but those are the prominent ratios he may want you to crunch on exam day. So take note of those parameters, those areas of ratios for you to be able to provide credence and also compute them. And please practice so that you can be speedy, so that you can be very, very speedy. It's very important to practice in these few 3 to 4 days you have. All right, so let's get to the very important part, which is the report. So the report, don't forget our format. Our format, after we've spoken to the first appendices, everything we did now on the ratios is 4 marks. Don't forget, without your writing. So first, let's have our first box on a general overview of the business. So our header, first main header is the evaluation of the financial position and performance. Then our subheader is on data and information. We're looking at a general overview. So we said this company's financial statement indicates a declining and loss-making performance. So you can deduce this from even the unseen. Looking at the numbers, we know the company is reflecting significant financial distress and operational inefficiencies. That's a general overview. You don't even need to crunch ratios or numbers or adjustment to see that the company is already distressed. Second overview is that we needed to adjust for some errors, omissions, impairments, and governance issues before performance evaluation. Then we said in 2023, the financial adjustments include write-down on recorded liabilities like we saw in the exhibit that gave us the numbers. Then another overview, we said National Cocoa reported high compliance issues, quality control concerns. So your overview should be on very salient issues that are replete. You don't have just one. This is just a prototype. This is a roadmap. Any overview that comes to your mind for you to pick 4 superior achievements, please bring them under this box to pick 4 marks. And the next box we're talking about now is your ratios, where you bring your ratios and the computations to bear. So we first talked about the adjustments, the numbers, and all we adjusted, and we referenced the appendix. Secondly is the adjusted profit and loss and revenue, and the resultant gross loss and everything that permeated in the exhibits, the appendices we computed for requirement 1. So thirdly, we said profitability deteriorated, and we also said while liquidity also weakened in just 1 point. So please be very succinct. 2-3 lines is okay for whatever you write under each box. Fourthly, we said the company is highly geared, looking at efficiency ratios and everything we said, we also always cross-reference the appendix. So whatever you do in every box, in this second and third box, make sure you cross-reference the appendix because that's where your computations are. And you're telling the examiner you did the appendix in the calculation. So always cross-reference your appendix is very important. The third box is our trend analysis. We're now looking at, they are testing our analytical skills. So we're looking at how they perform over the years. And we're saying that from 2023, 2022, it worsened. Retained earnings also stood at this figure. And in 2022, you see it worsened also, indicating persistent accumulated losses. Cross-reference the appendix. Current ratio worsened. We have this undisclosed related party of 42 million we brought here as an issue. You may not want to bring it here. Any numbers you want to bring, you can bring it and replace these undisclosed related parties. This can feature as a challenge or consideration and also an ethical issue because it deals with conflict of interest. But if you're analyzing it under the third box, it's fine. You can also be given your mark for that. Yes, Mandy, your hands are up. Please go ahead. Yeah, Amanda, you can speak, please. Unmute and speak. Your hands are up.
Oh yeah. I didn't unmute myself. So what I said is that this trend analysis. So I observed that you are analyzing it based on this adjustment that you did. What of if there was no adjustment? Are we meant to, like, how should we put it?
Exactly. So if there are no adjustments, it's the same numbers you use. You just compare both years and tell if there is positive improvement or negative improvement. That's all. So the adjustment is just to reflect the numbers that were adjusted. And if you don't want to use the adjusted figures, there are other parameters to use, but you must attend to the adjustment in the appendix. So there are areas that were not adjusted in these numbers. So you can use those areas to buttress your analytical skills or trend analysis. Very few numbers were tweaked based on the adjustment. So if you don't want to use the adjusted figures, you can use other figures you computed in the appendix and bring it under this box. I hope that's clear.
Yeah. Thank you, sir.
Okay, you're welcome. All right, so having spoken to trend analysis, the third box, your fourth box now will now speak to the challenges the company is facing and also some considerations. So first, we are saying this company is technically insolvent after the adjustment because total liabilities exceeded total assets by this amount. So this is a challenge resulting in negative equity. We now say the company is facing regulatory sanctions. This could also come as an ethical issue, but it can come as a challenge here. We said management may also be using creative accounting practices to obscure the true extent of SPL's declining financial performance. This is also a challenge. So everything here, because of how the company is facing, we don't have any consideration. Everything are challenges here that we are replacing. So many are there. Don't waste your time to be listing them. Don't overflog a box and leave other boxes. All you need is 4 superior points for superior achievement. So the company has a lot of issues, doesn't mean you should write 10 points under a box and waste your time. Please balance your time. It's very important. Balance your time so that you can attend to requirement 2. Next box, number 5, is our ethical issues. And I said you must have this box. This is a must box, a mandatory box. The other 4 boxes, if you don't like this format, you can maybe write them straight down. But you see, you must have an ethical headers box. It's very important. You must have an ethical headers box. So first item is on the financial statements not audited or incomplete. We say with a risk that management has not fully disclosed additional adverse information that could materially affect the reports. So it has not been audited. So that's an ethical issue. Secondly, we say the pressure to achieve reported results represent a clear ethical breach as it compromises objectivity and may lead to manipulation of financial information. Another ethical issue. Secondly is the 42 million. You see, we said this under which box now? You see, we said this under an analysis box. And we are bringing it here as a different ethical issue box. So you can repeat points as long as they resonate with that header. And you'll be marked. The fourth ethical issue we spoke to is the fact that the National Cocoa Commission's letter indicates widespread systemic weakness. Another ethical or critical compliance issue. So you always have ethical issues. Make sure you talk about them in each box. Now, box number 6 is also an optional box, and we're looking at risk assessment, where we said the negative retained earnings have exceeded its share capital and deposits, and that indicates severe capital erosion risk, which is downside risk, alongside the potential restructuring opportunity, and that could be upside if they restructure the business. So you see, your evaluation of findings or your risk assessment should be both sides. You're looking at negative and positive and weighing on both options. We spoke to trade receivables and the credit risk it affects and how it exposes the company to supplier issues. Next is the heavy reliance on trade payables as the primary funding and could lead to long-term solvency and sustainability risk. Next issue we are evaluating is on the quality control issue that may indicate potential fraud rather than purely operational lapse. So many risk issues or evaluations of findings should come under this box, and you could analyze that very pragmatically. All right, so we'll now conclude by saying that the company is technically insolvent. And we said it's evidenced by the negative retained earnings of approximately this amount, indicating severe erosion of shareholders' value. We've concluded on that. Secondly, we said the company is experiencing severe liquidity crisis, as evidenced by critically weak working capitals, indicating inability to comfortably meet short-term obligations. We also spoke to the quality control managers' unethical conduct and related party issue, and also the financial position deteriorating significantly from 2022 to 2023, with increasing risk of regulatory sanctions and potential customer claims arising from governance reporting issues. So what's our recommendation? So based on this first issue, we're recommending that the company should inject at least 1 billion naira fresh equity within the next 12 months. So you see, we are specific what they should do. We're specific, and we give them timeline to eliminate the accumulated losses, restore positive retained earnings, and strengthen its solvency position. So your recommendations should be smart. Like I said, I always say in previous debriefs, specific, measurable, attainable, realistic, and time-bound. So every conclusion should be attended with a smart recommendation. So you see, this conclusion number one is attending to, recommendation number one is attending to conclusion number one. Recommendation number two on formal restructuring of creditors and liquidity pressure is attending to this number two. Conclusion number three on investigating the issue of quality control is attending to number three. And conclusion number four on financial deterioration, we said should implement a formal and also independent forensic audit covering these transactions within 3 months to strengthen accounts. So every of your recommendation should attend to your conclusion, very importantly. So read through it and practice with your own words, writing your own words to ensure that you provide credence to how you attend to conclusions and recommendations, because box 7 and 8 are very, very mandatory. You must conclude and recommend. You must conclude and recommend. Yeah, Blessing's hands is up. Please go ahead, Blessing. Your hands are up.
Yeah, thank you for so far we have gone through. My question is, can we this, because from the financial statement, it shows that they have fixed deposit. Can we see that they could use the fixed deposit instead of injecting this 1 billion? Can we put it in such a way that they should liquidate that fixed deposit and inject it back into the business?
Yeah, so they can't use fixed deposit. Why? Because their current assets are also having issues. So it's not a good recommendation. So if you look at your current asset, your current asset is about 704. Total as current asset is 133 for 2023. For 2023 is 107. Go to the current liabilities. You see, your current liabilities is 494. Did you see that?
Yes, sir.
So you see, the company is technically insolvent. They can't even meet their day-to-day obligation. Your current asset is 107, and your current liability is 494. And you now want to remove fixed deposit to go and put it as equity. You are like robbing Peter to pay Paul, and you are also removing. You are going from frying pan to fire. Do you understand?
Yes, sir. Thank you.
So you can see where the problem is. So taking the fixed deposit is immaterial. It won't change anything because the total assets and the equity are not affected by the fixed deposit. So that recommendation of 1 billion, since you have about 800 and something million negative retained earnings, yes, loss. So 1 billion should be able to cushion that. Yes. So that's why that recommendation is coming.
Okay. Thanks so very much, sir.
All right. You're welcome. You're welcome. Okay, so good questions. Everyone is bringing good questions. There are no frivolous questions. So good questions. And thank you for them. So based on these recommendations we looked at, you must understand that the company is in need of your recommendations, and this is the way out. So structure your recommendations in a way that you are not vague and you are not generic. You are very specific in your recommendations. Be very specific in your recommendations. So having done that, I'll recommend very practically that after you finish requirements 1 boxes and your discussion, please go and do your executive summary. You don't have time. Go and carve out your executive summary quickly. It's very important. It's a good method. Don't want to finish the discussion requirement 1 and 2 before you go and do your executive summary. You don't have time. So go and start out the executive summary. So the executive summary has what the aim of the report for requirement 1 and 2, then the method of analysis, then also the computations in your appendix. Make sure you reference that. Then what the report is about, what it assumes. We assume our assumptions should be provided, or any professional skepticism you have. So we said, based on the financial assessment of profitability, efficiency, and capital structure, we found out that there's slight improvement in operational losses, showing weak but positive control trend between 2022 and 2023. Just a finding, but there's still issue of losses. Negatively, we said continued growth losses reflect persistent core profitability weakness. So in conclusion, 4 points. The company is technically insolvent with negative retained earnings. Simple. No stories, short line, one word. Secondly, the company faces severe liquidity crisis. Thirdly, the pressure on quality control manager constitutes unethical behavior. Fourthly, the undisclosed related party transaction with Mr. Zamani Garuba is a conflict of interest. Next is the company's financial position worsened significantly from 2022 to 2023. Your conclusion should be very short like this. Don't waste time and energy writing in your executive summary. It's a snapshot of everything you have done. Their recommendation should attend to your conclusions in your executive summary. Short. Injection of equity working capital to address to this. Immediate restructuring of trade payables to attend to number 2. Disciplinary action against management to attend to number 3. Full disclosure of related party transaction, attend to number 4. Implementation of robust controls over, attend number 5. Simple. Then requirement 2. So your executive summary should be very sharp, and it should 1 page minimum, 2 page maximum. Very simple. That's your executive summary. So take note of it. It's good to finish requirement 1, then come back to requirement 2 for executive summary, then finish requirement 2. If you have time, which I doubt, at that time they'll be telling you, but at least attempt requirement 2. The challenge is always to start requirement 2. Don't leave requirement 2 unattempted, please. Attend to requirement 2 is very important. All right, so having spoken to financial statement analysis, before we get to the second requirement, do we have any other questions? Any contributions, observations?